Did you know that if you had invested just $100 a month in the S&P 500 starting in 2010, you'd have over $25,000 today? Meanwhile, that same money sitting in a savings account would be worth only about $12,500. The truth is, not investing isn't playing it safe, it's actually a guaranteed loss. In this video, I'm breaking down exactly how much money you're losing every single day you stay on the sidelines and why it's way worse than most people realize. The hidden tax of financial inertia. What if I told you that by not investing, you're essentially paying a massive invisible tax that grows bigger every year? It's true. This hidden tax isn't collected by the government. It's the money you're leaving on the table by keeping your cash idle. Financial experts call this opportunity cost, and it's silently draining your future wealth while you might not even realize it. Here's what's really happening when your money sits in a basic savings account. Inflation is constantly eroding its value. While you might feel safe seeing that same number in your account, the purchasing power is shrinking year after year. Like sand slipping through an hourglass, inflation quietly diminishes what your dollars can buy. When inflation runs at 2 to 3% annually, but your savings account pays less than 1%, you're actually losing money in real terms. That gap compounds over time into a significant loss. Let me show you how this plays out in real numbers. If you put $10,000 in a typical savings account back in 2010, today you'd have about $11,200. But if you had invested that same amount in an S&P 500 index fund, you'd be looking at over $45,000. That's 4 times more money simply by making a different choice with the same dollars. This gap widens exponentially as time passes. After 30 years, the difference between invested and uninvested money can be 5 to 10 times your initial investment. This demonstrates compound interest, which Einstein reportedly called the 8th wonder of the world. Your money makes money, and then that new money makes even more money. Many people fall into what I call the psychological comfort trap. Keeping cash feels safe. You can see it, count it, and it doesn't fluctuate in nominal value. But this security is actually an illusion. By playing it safe, you're guaranteeing yourself a loss of purchasing power over time. Inflation is the silent wealth killer that most people ignore until it's too late. Consider the monthly cost of staying uninvested. With $5,000 sitting idle, you're missing about $33 per month in potential growth based on historical stock market returns. With $25,000 uninvested, that's $167 monthly. And with $100,000, over $650 every single month, real wealth that could fund your retirement, your children's education, or that dream vacation home. If you invested just $100 monthly, the difference becomes even more striking. Over 10 years, a savings account might give you $12,600, while a stock market index fund would grow to approximately $18,300. After 20 years, the savings account provides $25,800 versus $49,200 in the index fund. And over 30 years, $39,200 in savings compared to $122,700 in the index fund, more than triple the growth from the same contribution. Different investment vehicles offer various risk-reward profiles. $10,000 in U.S. Treasury bonds from 2010 would yield about $15,900 today, lower return but with reduced volatility. The same in a total market index fund would be worth around $44,000, offering higher returns with moderate risk. A real estate investment trust, REIT, index would give you approximately $36,000, balancing income and growth potential. What makes opportunity cost particularly painful is its invisibility. You never see a statement showing what you could have earned. It's the wealth that never materializes, the future lifestyle upgrades you'll never experience, and the financial security you could have built but didn't. The difference between modest and comfortable retirement isn't just a larger number, it's the freedom to truly enjoy your golden years. Breaking through mental barriers to investing. The psychology behind why we avoid investing is anything but simple. Did you know that 61% of Americans find investing in the stock market scary or intimidating, yet the average investor who stays in the market for 20+ years has never lost money? This gap between perception and reality is costing millions of people their financial future. So why do we hesitate to put $1,000 into an investment that could multiply but will happily drop that same amount on the latest smartphone that loses value the moment we walk out of the store? Please like and subscribe if you like the videos, and share with your friends and colleagues. The answer lies in how our brains are wired. Let's break down the 4 psychological barriers standing between you and your wealth. Fear of loss makes us feel financial pain twice as intensely as equivalent gains. When your investment drops 10% in a week, your brain's alarm system screams danger, despite history showing markets always recover long-term. During the 2008 crisis, countless investors sold at the bottom, turning temporary declines into permanent losses, while those who stayed invested captured the decade-long bull market that followed. Here's how to flip this fear into opportunity. View market dips as sales, where your dollars buy more shares of your future wealth. Decision paralysis combines information overload and analysis paralysis into a wealth-killing cocktail. When facing thousands of investment options, each with their own metrics and terminology, your brain simply shuts down. You keep researching without action, waiting for the perfect time or investment that never arrives. Meanwhile, time in the market slips away. Studies show investors who attempted perfect timing earned 1.5% less annually than those who simply stayed invested. The antidote? Simplify your starting point with one low-cost index fund tracking the entire market. As Warren Buffett advises most people, a straightforward S&P 500 index fund eliminates the paralysis of endless choices. The false belief that investing requires large sums prevents many from starting at all. This mental barrier creates a dangerous procrastination cycle. Each day you delay is another day compound. Growth isn't working for you. Psychologists call this hyperbolic discounting, choosing small, immediate rewards over substantial future ones. It's like planting a sapling. The best time was 20 years ago. The second best time is today. Even $50 monthly builds significant wealth over decades through the magic of compounding. Set up automatic transfers to remove the decision. Entirely consistent, small investments outperform sporadic large ones. These psychological barriers aren't permanent roadblocks. They're hurdles you can leap with awareness and planning. Create an investment strategy before market turbulence hits so emotions don't drive decisions. Automate your investments to bypass the need for constant choices. And remember that building the investing habit matters more than your initial amount. By understanding and overcoming these mental blocks, you transform from someone paralyzed by financial fears into someone who harnesses psychology for wealth building. The most successful investors aren't necessarily the smartest, they're the ones who've mastered their own minds. Conclusion: so now you understand the real cost of sitting on the sidelines. But here's the truth: inaction isn't playing it safe, it's actually guaranteeing a worse financial future for yourself. Look, I get it. Investing can feel intimidating at first. Taking that first step is crucial. Even $50 or $100 each month compounds dramatically over your lifetime, like planting seeds today for a forest of wealth tomorrow, ready to take control. Start today. Every day you wait is potential growth lost. Imagine the financial freedom awaiting those who begin now. Drop a comment about which investment option you want me to break down next. Let's build your wealth together.